Good morning, and thank you very much for joining us today on this CPE session, which is going to cover what's new from GASB, an update on the latest standards. So let me introduce myself. My name is Robert Lemon. I am an audit partner with Carr and Ingram, specializing in the governmental industry, and I will be your moderator for today, trying to keep things moving. Really appreciate everyone attending these sessions. We've had really good feedback, and I think the presenters do a terrific job. Today is no exception. We've got two wonderful presenters with us. And this is the fourth governmental specific CPE session that we've done, and we plan to do more. So we're currently doing our planning for next year's agenda, and these are part of it. We expect to be doing some more. So if anyone has particular topics they'd like to see us cover in future CPE sessions, feel free to drop those into the chat, and we shall consider that in our planning. But with that, let's get moving here with the slides. I can see we are struggling with the slides just a second. So let me see if I can move this along. Okay, we'll get these slides working in just a second, but whilst we do, I'll introduce our wonderful presenters. So first up, we have Tina Stewart. She is also a partner and a governmental specialist, and she is in our corporate office. She oversees our entire governmental practice from a kind of governmental corporate technical perspective. So she is really knowledgeable on all this subject. She's going to have some great insights onto these GASB subjects, and we're going to pick her brain and get a lot of good information. Also with us today is AJ Bowers. So I apologize if your screen's changing at the minute. We're just fixing the slides here, but you'll see AJ Bowers is with us also today. He's a governmental partner from our Albuquerque office, and he has some really good knowledge on GASBs. He's on a number of good committees and groups that know the technical stuff inside and out, and he's going to be a terrific resource today. So we have a lot of slides today. We're going to move fairly quickly. So I just want you to be aware of that. Please raise questions in the chat if you have any, and we'll slow down. Remember today, the slides are working, excellent. Remember today, it's worth 2 CPE credit hours. To get the full credit hours, you must answer, not get correct, but answer 80% of the polling questions to get the full credit. After the session, within 7 days of today, you should get your CPE certificate. They'll come from the certificates at simplecert.net email address. And if you do have questions about your certificate, there's the email address to contact, marketing@cricpa.com. So there we go. That's the background for what's going to happen today. I hope you enjoy the webinar. Here's the presenter slides, which I talked on, but we're going to skip through these pretty quick because I've introduced our wonderful presenters today. One thing I want to point out, as I say, we're going to move quickly. We're going to try and address all Q&As that come up today. We're going to do our office hours right at the very end, which is where we take questions. Now, we do have a lot of content, and if we run out of time, we will answer any questions that have come in via email afterwards. So don't worry about if your question doesn't get answered here today, it will get addressed via email afterwards if we run out of time. Also, with the time issue being said, what I'm going to do for the polling questions, I will launch it, leave it up for a little while whilst we do the next couple of slides to keep things moving. But do be answering those poll questions. You need 80% answered to get CPE credit. So that's a long intro. I said we're short for time, so I'm going to get moving now. Today's agenda, we've got the overview, and we're going to get straight into it here. I can see from the slide. We're going to go with GASB 83 as our first one. So I'm going to turn it over to our wonderful presenters and get started.
Thanks, Rob. I really appreciate that. I'm happy to be here with you all today. My name is AJ Bowers. I'm a partner out of Albuquerque, like Rob said. A couple things as just from a housekeeping perspective. One, I want to thank GASB. GASB sent these slides to us for the most part. We made some tweaks to them, but a lot of the stuff comes directly from GASB. So there's been some updates since we received this one back in about April. And so we'll try to keep those as clear as possible. And then second, as Rob said, is I am on some various committees. So I do sit on the TIC, the Technical Issues Committee of the AICPA. And so we do meet with GASB, and I'll be meeting with them in September. I actually had a call with them a couple of weeks ago. But these are, all of this information does not represent the AICPA or their opinion or the TIC. It is the opinion of CRI. So just need to make that little disclaimer anytime that we do that. So what we'll do today is we can jump in here to 83s. We're going to just kind of make a quick run through of every current standard that's going on, if there's a chance that it could still be implemented, and then a whole bunch of new items. So we'll spend the majority of the time on a couple of the larger statements. So 83, as we talked about, is certain asset obligations. So if you look at when the statement's going to be implemented and what the purpose of it is really there were a few items out there that there was some diversity in practice. Okay, so 83 is really, there's only a few people that haven't implemented this yet because of the delay with 95. This was one of the ones that was delayed due to COVID. And so there was a little bit of that delay. And so the only thing that's really not in there is if you look here on this next one, it talks about what an ARO is. And so an asset retirement obligation on the next slide, it will say the legally enforceable liability associated with the retirement of a capital asset. So if you're permanently removing an asset from service, sale, abandonment, recycling, or something like that, there might be some sort of retirement obligation that goes along with it. Now, this basically, there's a couple different examples that are within here, nuclear power plant decommissioning or coal ash pond closure, but there's going to be a contractual required land restoration. So it's a legally enforceable claim. This statement itself excludes landfills, pollution remediation obligations, and then conditional obligations. Those are all covered under statements 18 and 49. So if it's outside of those and there's a legally enforceable liability with the retirement of a tangible capital asset, you may have an ARO that you have to record. So that's all we're going to spend our time on for AROs. And we'll talk about fiduciary activities. So statement 84. We've done a lot on 84. You may have heard some of my presentations on 84 over these last couple of years, but it's here. It was delayed due to 95 last year. And this statement here is really in order to clarify what was going on within practice. Okay, and this is related to all fiduciary activities. Now, when we look at what those are, so this statement, as we move forward onto this next one here, is going to talk about establishing the criteria for identifying what the fiduciary activities are and those reporting requirements. Okay, so under statement 34 previously, it talks about fiduciaries, it talks about agency funds, it talks about how we have to report those, but there's been diversity in practice. There's been diversity in how it needs to be reported. There's been some the way that people have identified what are fiduciary activities has varied for 20 years. So with 84, this is really a clarification statement. So a couple of things I wanted to draw is we're going to talk a little bit about what is identifying those fiduciary activities and then the reporting differences. And then one thing, if you're a BTA model and you've never reported those fiduciaries before, you should. Okay, so there's been diversity. There are some, like in college realm, there's a lot of colleges that don't report them, and there's a lot of colleges that have. You should be reporting those fiduciary activities on those financial statements. So when it talks about what identifying the fiduciary funds are, they came up with some new definitions as it relates to pension trust funds and investment trust funds, private purpose funds. Okay, so it kind of clarified what those are. And then the big one to me that I think is going to be the largest change for most people is the custodial funds. So any sort of custodial fund is going to be reporting those fiduciaries for where there isn't a trust agreement. Okay, so or some sort of equivalent arrangement. So what is this other path? And so we're going to jump in and we're going to look at there's 4 paths to the determination. The first 3, okay, component units are 1 and 2. So component units that are post-employment benefits, component units that are not post-employment benefits, that's path 1 and 2. Path 3 is a post-employment benefit that's not a component unit, and path 4 is other, right? So what we're going to primarily focus on is path 4 as it relates to custodial funds. So if you look here, this is from GASB. Okay, so this graph here, this flow chart is from GASB slides itself, and it talks about this is a path that you walk through. Are they component units? Yes or no. And then you get down into, are they held for a pension or OPEB? Yes or no. And so paths 1 and 3 are virtually the same, with the difference of the component unit, and paths 2 and 4 are essentially the same with the exception of the component unit. So as we jump over here as to when it talks about what path 1 is, there's a lot of definitions that we're going to look at that are going to be very similar. So like I said, we're going to focus on 4. So path 1 here is basically a pension that's administered through a trust and meets the criteria of statement 67, or an OPEB under 74. That's the majority of what we're looking at, and that would be path 1. Path 2 is if it's a component unit, but it is not a benefit, you're going to go through these tests, and we'll talk about these really within path 4 since they're so same, because it's so similar, and they're going to define, this administrative involvement, and it's going to define this direct financial involvement. Okay, so how do you have these assets that are sitting in this component that are really for some other organization, some other individual? Path 3, this is extremely rare, because this is where it's not a component unit, but it's still a pension plan or an OPEB plan. So I don't know what that looks like in practice personally. I haven't seen that, especially with the change within the component unit discussions really with 97, and we'll go through those briefly, but this is a rare situation. So I don't see that coming up a whole lot. Path 4, like I said, we're going to talk about the most. So there's 3 basic parts. 1 is that the government controls the assets. 2 is that those assets are not derived solely from the sole source revenue of the government, or from government mandated non-exchange transactions or voluntary non-exchange transactions. So basically it's not coming from the government's own funds, and then it has to meet one of the following. So that's where it's administered through a trust or a trust-like agreement where it's not the beneficiary, or it can meet where the assets are held for the benefits of individuals, where you don't have administrative involvement. And then the last, or it could be for the benefits of organizations that are not part of the financial reporting entity. So as we'll look at what those definitions are here in the next couple of slides. So on this next slide here, it should talk about the government holds the assets. So under paragraph 12 of GASB, it says that the government is going to control the assets if it has the ability to hold them and has the ability to direct the use or exchange of those assets. So the government holds them and can tell you how to use them, or the ability to direct the change. So what you're doing is you're signing a check, you're the one who's responsible for those funds. So when I think of school districts, those activity funds, they're being held by the government, and you're writing the checks to where they're supposed to be specified to. So once you step down into, when we talk about what own source revenue is, so it's kind of a double negative, okay, is that the assets are not from sole source revenue, okay? And own source revenue is going to be revenues generated by the government. So paragraph 13 talks about what those are. It's exchange and exchange-like transactions. So if it's coming from investment earnings, tax revenues, water charges, things like that, okay? And then you sort of impose not exchange, so like property taxes. So if the money is coming from the government's provision of resources, of the government's operational activities, then it's going to be its own source revenue, and it can't be coming from those. The next couple definitions that we're going to look at is what means administrative involvement and direct financial involvement. Okay, so a couple of examples here when we talk about those items is that administrative involvement is going to be: are you monitoring compliance with those activities and the activity that are established by the government? Are you determining the eligible expenditures? And if you have the ability to exercise discretion in how assets are allocated. Now, those are the definitions that come straight from the standards themselves. And it leads to think that if you're monitoring compliance and if you're determining eligible expenditures, there's very, very specific words in there that have to be defined as you go through this, each fund to do this determination. Okay, so as you work through, excuse me, as you work through those, you have to determine, what are you really doing? What are we asking our people to do? Are you just verifying that it's going to what the intended activity is? But are you responsible for monitoring compliance? Are you responsible for the determination of eligible expenditures? Are you exercising your own discretion as the primary government of how those assets can be allocated? And they're very subtle, okay? It's not to mention that direct financial involvement would be things, if you were to be providing matching resources for the activities, then you could be involved in those. So we have this quick assessment here. And I just wanted to mention that you might have this. It'll be here on this next slide, Tina. This is a sample assessment. So you're going to go through every fund that you have. So if you're a school district, this is every activity. Every activity that you're going to look at, you're going to have to determine, do we meet these 3 tests? Okay. I believe this is going to follow the 80-20 rule. So 80% of these is going to be pretty easy. And in most cases, the other 20% are going to be your challenging ones, because there's going to be something subtle between the differences that you're not 100% sure, but it's going to have to meet test 1. It has to meet both boxes on test 2, and it must meet one of the 3 on test 3. Okay, so as you walk through all of those to determine the control, the revenues, and those other items, you're really going to want to use the implementation guides. And we'll have an example of those here in a brief moment after we go through the first poll question.
Thank you, AJ. So I am going to launch the first polling question here, and I'll read it out. Like I said, get your answers in. We're going to leave it on the screen for a few slides. But the question reads, how many paths are there to determining when a government should report assets in a fiduciary fund? So I'm going to leave it on the screen and let the presenters continue for a little while here.
Perfect. So what we'll talk about right now, we'll look at these, we'll look at some additional guidance. Okay, so as I talked about, you don't want to implement without the implementation guide. I inherited a client that did do that, and there were some changes to that, as well as we'll also talk about Statement 97. So here on this next one, I just want to show the implementation guide itself, 2019-2, was specifically set up for fiduciary activities. Now, anytime GASB issues an implementation guide that is directed towards one specific statement, it means the statement's complicated and it's a big deal. Okay, so the effective date's going to align with it, but there's all these different sections in the guides, and there's 55 Q&As that go through different hypothetical situations and how you should treat them in accordance with the statement itself. Okay. And then other implementation guides, such as the 2020 guide came out, there were some questions that were specific to the fiduciary activities. And I thought that those were pretty good, just to at least draw out. And on this next slide here, we'll just have an example of what these look like. So this is out of the 2019 guide. So 4.21, the question is basically, the school board establishes and approves a policy related to disbursement of funds for various student clubs. They're not legally separate from the school district. The policy includes specific guidelines related to how the funds raised by the clubs can be spent. Does the district have administrative involvement? So when it goes down, you get to the answer, yes, they do, because they have a specific policy, specific guidelines. So they're actually making the rules. But then there's 2 questions right below it to say, assume the same facts in 4.21 except, and then assume the same facts in 4.21 except. And they're giving a caveat. And they're going to give a caveat as to what those guidelines are in different pieces. So it may not be your exact item, but you start working through and say, okay, there's these subtle differences between these questions that may change the outcome. So you work through those. So those 55 questions, very similar to that. And I just wanted to show that as an example. So Rob, do we want to go through are we good on the poll? And then we'll.
Yep, I think the answers have fully came in. So if anyone hasn't clicked an answer, do so now. You've got 5, 4, 3, 2, 1. I'm going to end the poll and share the results. There you go, AJ. There's your results.
Path 4. Perfect. 57% say path 4. So path 4, or there's 4 of them. So that is correct. There are 4 paths. Okay. And then briefly, I just want to mention GASB Statement 97. So I know it's out of order here, but when it relates to 97, they issued this at the end of, issued this last year, basically to amend GASB 14 as it relates to component units and GASB 84. And the reason for that is primarily there were some items, 457 plans was one of the biggest questions. A 457 plan doesn't really is that it was a defined benefit in some sort of, or defined compensation plan, but there was a post-employment benefit. And based on the criteria, those were kind of nudging into GASB 84 as a potential fiduciary component unit, which would therefore be subject to audit and everything else. And so in summary, what they did is they basically said defined contribution plans are excluded from the component unit determination as there's no separate board. So that excludes pass 1 and 2, right? The financial burden in paragraph 7 was updated. And so when it came to 457 plans, know the plan, you have to evaluate it. It didn't come up and say absolutely not. 457 plans are not part of the reporting, but you need to know any sort of plan. The main thing is a defined contribution plan is excluded, which means there's no obligation from the government itself. So you would exclude those on the defined contribution side. But if there's a defined benefit, if there's any sort of benefit, you have to evaluate that plan. So that was a clarification that we'd hoped GASB was a little more clear about, but as all things with GASB, it's not 100%. So definitely look at those. So if you have a 457 or if you have anything else that doesn't necessarily meet those first criteria, you have to evaluate those to determine whether or not need to be included in GASB 84 or not as a fiduciary. Now, one last change here with 84 before we move on is going to be the fiduciary activities presentation. Okay, so currently, our current presentation is in the basic financial statements. You've got a statement of fiduciary assets and liabilities, which is an agency fund. So, you know, your assets and your liabilities are the same and they equal each other. There's no net position or anything like that. And then you have a supplementary schedule, the schedule of changes in fiduciary assets and liabilities. So that's going to basically, you know, be your additions and your deletions of all of those different categories are going to tie to that statement of assets and liabilities part of the basic. Now, under 84 presentation, you're going to have a statement of fiduciary net position and a statement of changes in fiduciary net position. So you're going to have a restatement to put all of those on the books for the implementation 84. And because you know it's no longer assets and liabilities, you don't necessarily have a current draw on those resources. So it's going to sit there as net position, and then you have an income statement, in theory, as part of the basic. And then in the supplementary information, this is a really big point, is on the combining statement of fiduciary net position and a combining statement of changes in fiduciary net position, you're going to report those. That's really in accordance with GASB 34. So you're going to have a combining statement for those. If you do an ACFR, which we'll talk about, but if you do one with the GFOA and you don't put that in there, it is a significant comment from the GFOA. I've seen that in practice. Okay, so also part of those statements here on this next slide is going to talk about additions and your deletions should be disaggregated by source. Okay, so you can't just have it all as additions, and all those deletions are going to have to be disaggregated. So is it investment earnings? Is it, contributions? Those types of things you're going to have to break out. So you really have to track them more like regular funds and income and the types of income, the type of disbursements, in order to present that on the financial statement. And lastly, from the audit side, it's going to change some of the work that we do because of the opinion itself. So the opinions, currently you have an in relation to opinion on that schedule of changes. And on the GASB 84, it's actually going to be an overall audit opinion as part of the aggregate remaining funds. So when it comes to our actual work, it results in a little bit of different, it impacts the testing because we have to include that income statement as part of that opinion unit now. So it's going to change some of our scopes and some of the tests that we have to do. So I think with that, we'll move on to the last poll question for 84.
Excellent, thank you, AJ. So let me get this launched and then I'll read it out. Number 2, launching now. So polling question number 2 reads, GASB 84 changes the basic financial statements in relation to fiduciary funds from a statement of fiduciary assets and liabilities, agency funds, to A, the statement of fiduciary net position, B, a statement of in fiduciary net position, C, both A and B, or D, none of the above. So once again, I'm going to leave that on the screen and let the presenters go through the next couple of slides, and then we'll come back for the results.
Good morning, everyone. My name is Tina Stewart, and I am with the corporate office for Carr, Riggs, and Ingram, and I'm going to go ahead and take y'all through GASB 87 leases. And I know there's a lot of questions on GASB 87 and a lot of information. So my thought process is we would go through the actual GASB, and then I have a couple of are actually about 3 examples we could go through that maybe will address some of your questions on this standard. So just a quick overview, GASB 87 was to improve lease accounting and financial reporting. It's really also getting in line with the FASB because of the new lease standard on the FASB side as well. It was one of those that was also delayed by statement number 95. So although early implementation is encouraged, it has been delayed for 18 months, but I would think that everybody's getting in line in order to address some of the major impacts that GASB 87 has on it. So with GASB 87, we have debt limits and bond covenants. All the leases lasting more than a year will now be reported by lessees as long-term liabilities. So this is probably going to have this will have an impact on state and local laws and agreements to determine whether it could impact compliance with debt limitations and bond covenants. We need to look at lease policies and procedures and need to consider whether changing policies and procedures for tracking and reporting leases both at the lessee and the lessor level. Also, we're going to need better communication between departments that enter into leases and central accounting staff. So a good example of this is if you're a municipality and your sheriffs have a sheriff's office or a police department and they decide to go get a copier lease or a lease for their radios, those now really need to be looked at the higher level to make sure that it doesn't have an impact on reporting the long-term leases that need to be reported within accordance with GASB 87. We need procedures that will identify when lease agreements have been initiated and when existing leases are modified. So such changes in lease term or estimated pay amounts, those will need to be taken into accordance for GASB 87. You should be reviewing your capital asset policies, such as capitalization thresholds, especially in light of the need to report intangible right to use assets. So some of the transition provisions for GASB 87 is that it's going to recognize at the start of the period. So therefore, if you have a fiscal year end of June 30, 2022, well, then it's going to start as of July 1st, 2021 for single year presentations. And we've listed some of the examples here, such as September 30, 2022, it's going to be as of October 1st, 2021. For comparative presentations, however, you're going to have to go back from the inception date. So or the inception for the comparative aspect. So if you have a June 30, 2022, you're going to have to look at it as of July 1st, 2020. So I wanted to go into the scope and approach and some exclusions we'll also go through. So the scope is a lease is a contract that conveys control of the right to use another entity's non-financial asset, the underlying asset, for a period of time in exchange for an exchange-like transaction. So the right to use asset is that specified in the contract. Control is manifested by the right to obtain the present service capacity from the use of the underlying asset and the right to determine the nature and manner of the use of the underlying asset. So leases are financing of the right to use an underlying asset. So therefore, this single approach will be applied for all your leases. This means it'll hit your operating leases, your capital leases, it'll hit all leases with some exceptions, and such as short-term leases will not be impacted by GASB 87. Some other exclusions are going to be your intangible assets, such as mineral rights, copyrights, patents, software, biological assets, timber, living animals, inventory, service concession arrangements, and we'll go more into service concession arrangements when we talk about the impact of GASB 94 on GASB 60. Assets financed with outstanding conduit debt, unless both the asset and the debt are reported by the lessor. Supply contracts are not going to be included in GASB 87. So this is just some of the items that are scope exclusions of GASB 87. Some common inclusions and exclusions are cell towers and grazing leases, and some exclusions are airspace and permits. However, things like land easements and right-of-way, those are going to be things we have to analyze and determine should this be excluded or included due to the standards that go into GASB 87. So some specific inclusions maybe is the contract for services. Is it covered under GASB 60? Is there an underlying asset, a financial asset that's going to be defined by GASB 72? Is the lease for an asset excluded from the scope of 87 that we spoke of earlier? Is it an intangible? We need to ask ourselves these questions in order to determine, is it going to be specifically excluded? And Rob, did you want me to take a pause here so you could close your poll?
Yeah, that sounds like a good point. I think last 5 seconds, if you want to quickly get an answer in, get credit here. Remember, you have to answer to get your CPE credit, but I'm going to go ahead and end polling question 2. And I will share the results. And then back to you, Tina.
All right, looks like 76% said both A and B, and 76% would be correct on GASB 84. All right, with that, we'll go into finance purchase is not subject to GASB 87. So you'll ask yourself, does the contract transfer ownership to the lessee by the end of the contract? Does the contract contain termination options or fiscal funding clauses? Is it reasonably certain that the fiscal funding or cancellation clauses will not be exercised? These are all questions we should be asking ourselves in order to determine, is it subject to 87? These are the biggest ones to me, though, that you need to ask. Does the contract have a fixed or fixed in substance payments? Do both parties receive and give up essentially equal values? Does the lessee have control of the right to use the asset? Is the maximum lease term greater than 12 months, including options to extend, regardless of probability of being exercised, but not indefinite? And is the contract term not indefinite without cancellation options? What if we have separate lease and non-lease components? So this happens. If we have a lease and it's, let's say for a copier, you might have a piece of it that's going to be subject to 87, but maybe they have a service arrangement of the copier that's not going to be subject to 87. So separate lease components we need to segregate out from those that are going to be impacted by 87 and those that will not be impacted by 87. Services are non-lease components. So maintenance, CAM, utilities, those are all non-lease components. We need to allocate the contract price based on the reasonable individual component prices. We need to maximize the use of observable information and estimates if individual prices are not available or unreasonable. And we only if we estimate individual prices, is it not practical to make multiple component contracts be accounted for as a single lease unit. And remember, on these service are non-lease components, that we're going to cover that with GASB 60. And with that, I'll go into polling question 3 to Rob.
Thank you, Tina. I'm going to launch this and then read it out. So polling question 3 reads, which of the below would be considered finance purchased and not be recognized under GASB 87? Is it A, the contract transfers ownership to the lessee by the end of the contract? B, the contract contains termination clauses or fiscal funding clauses? Is it C, it is reasonably certain that the fiscal funding or termination clauses will not be exercised? Or D, all of the above? So with that, again, I'll leave it on the screen and let you proceed with the next couple of slides.
So now you've gone through all the steps to determine, are we going to report this under GASB 87 or is it not to be included under GASB 87? I think that's your easiest part, is trying to determine yes or no. And now we need to determine how are we going to report it. So for the lessee, your asset is going to be the intangible lease asset or the right to use underlying asset, the value of the lease liability plus prepayments and initial direct costs that are ancillary to place the asset in use. And then there will be a liability to the present value of the future lease payments. That's a key part. It's just not the future, not the lease payments. It's the present value of the future lease payments. This will include fixed payments, variable payments based on index or rate, reasonably certain residual guarantees, etc. However, for the lessor, you're going to book your lease receivable, or you'll just continue to report the leased asset, and a deferred inflow equal to the lease receivable plus any cash received up front that relates to a future period. Any initial direct costs that are considered to be debt issuance costs should be expensed. In the statement of cash flows, payments should be classified as financing activities. Lease incentives, essentially rebates or discounts, also impact measurement of the lessee's lease asset and liability and the lessor's receivable. We're going to go through a few examples, and I'm going to push this all into that once we're through these initial slides. For me, it's easier to see through example than it is just to have the words, and I hope it's more effective to have some examples as well. So once you've had your initial recording of the lease, the lessee will amortize the intangible lease asset over the shorter of the useful life or the lease term, and you're going to reduce the liability by the lease payments. For the lessor, you're going to depreciate the leased asset unless it's some type of indefinite life. So for the majority of them, you're going to just depreciate the leased asset and reduce the receivable by lease payments. At this point, you will recognize revenue from the deferred inflow over the lease term in a systematic and rational manner. So short-term leases. At the beginning of the lease, the maximum possible term under the contract is 12 months or less. For the lessee, you will recognize expenditures based on the terms of the contract. Do not recognize assets or liabilities associated with the right to use the underlying asset. For the lessor, recognize lease payments as revenue based on the payment provisions of the contract. So basically the 12-month, if it's not over 12 months, it's not considered in GASB 87 and you're expensing it at that point. And with that, I'm going to go ahead and hand it to Rob for another polling question.
Okay.
And I'll let him close out the last polling question.
Perfect. Yeah, last chance to get your answers in for polling question 3 to get your credit. I'm going to close that and share the results, and then I'll do question 4, and then Tina can speak to both the results. So ending 3, sharing results. You can see all of the above was the favorite with 65%. And
all of the above was correct.
Awesome. And here is polling question number 4. And this reads, a lessee will initially report an intangible lease asset and a liability amount that is equal to, is it the contract, the fair value of the leased asset, all payments added together, or the present value of future lease payments? So I'm going to let as always, let the presenters speak for a little while, and then we'll come back to the results.
Okay, so the examples I'm just going to kind of verbally go through without having actual slides, and just go through some things that I think would be best for implementation, especially for an initial or ongoing. So the first example we'll go through is the lease of equipment by a city. So if a city enters into a lease contract to obtain equipment, the lease begins on January 1st, 2021, and the first day of the city, which is the first day of the city's fiscal year, and is for 60 months. So this is a 12/31/2021 year end, and it's for 60 months as the lease. However, the city has an option to extend the lease for an additional 24 months. The city's unsure whether it will exercise the option to extend the lease. After the end of the 60 months, if they choose to extend, it'll be 84 months. So the question is, what is the lease term? The answer would be 60 months because the city is unsure if they're going to extend, and they're not positive they're going to utilize that 24-month additional option. So with the same lease, we're going to talk about how we would look at the payments. So the base monthly payment is $1,000 due on the first of each month and includes 200 machine hours. If the city uses more than 200 machine hours in a month, it is required to pay $5 per excess hour. In addition, the contract requires an $80 monthly payment for repairs and maintenance, which is a reasonable amount for those services. During any month-to-month period, each monthly payment can be adjusted upward based on the consumer price index within 30 days notice. The lease contract states an interest rate of 4%. There's a separate contract with the lessor for delivery and installation of the equipment, which is for $1,500, which is due at the first lease payment. So the question is, what is the initial measurement of the asset and liability? How would we do this? So we would say there's a base payment, which we know that's $1,000 a month for 60 months, and it'll be discounted at that 4% interest rate. So we'd say $1,000 a month at 60 months would be $60,000. Discounted at 4% would be at about $54,480. The excess use charge, we would not put that into our base rate. And the reason is because variable payments based on future usage are excluded from GASB 87. The repairs and maintenance would not be included in our payment in our fixed rate. And the reason is because service components are excluded from GASB 87. So the initial value of the lease liability is $54,480. What we would include there, though, is the installation and delivery. So we would add that $1,500 at that point for that. So here's the initial year of doing it. How would we go ahead and record this? That's the big question that comes to mind. So we would go ahead and we would debit our capital outlay asset, and then we would credit other financing sources, lease proceeds, and cash for the $54,480. And the cash of $1,500 that we have to do immediately for the delivery. Your government-wide is going to see that we're going to hit the other financing sources and put it back into a lease liability. So we would go from that on the government-wide, we would hit that lease liability, and that would be the only change. And then we would also record that capital outlay on the books. Did you want to go ahead and close out that polling question, Rob?
Yeah, and I was just going to let the audience know that the examples Tina was providing weren't in the slides. They were just extra examples whilst we have time to look through the polling questions. If you're wondering whether the slides have stuck, they have not. Those examples were on the side and not in the slides. So that just addresses a few questions that came in. But last couple of seconds here, get your final polling question answers in, and I'm going to close it now. And I will share the results. Tina?
And D is the correct answer, the present value of the future lease payments. Okay, in subsequent years, you would go ahead and, like I said before, you would end up debiting interest expense and debiting your lease principal payment expenditure as payments were made throughout the years. With that, I'm going to go to another example, which is an office space example related to a component unit. If a city enters into a lease with a discretely presenting component unit who both have 6/30 year ends, the city's current rental agreement has expired, and the city is electing to relocate to a new larger space offered by the component unit. As part of the agreement, the component unit has to install entry security access at each entrance within the first month of the agreement. The cost of the installation is $2,500. The agreement begins on July 1st, 2021. The term is for 1 year with an option to extend each year for the next 4 years. With prior agreements, the city has elected the options to extend, and they intend to do the same with this. So the question becomes, what is the lease term? Because we know that they probably are going to extend to the 4 years, your lease term would be for that 5-year period, and therefore it would be a 60-month lease. The initial measurement of the asset and liability would be that you would say that $2,500, the agreement calls for monthly payments due on the first of each month of $1,962 with no stated interest rate. So you would just take that 1962 and multiply it out by the 60 months in order to get your initial measuring amount. But then you would have to go ahead and find the present value of those lease payments. And since the lessee's estimated incremental borrowing rate is 4%, we would utilize 4% at that point. The initial entries by the component unit would be to a lease receivable and deferred inflow for the amount of the present value of that lease. And from there, you would recognize payments as received. So as your payments were, the subsequent payments were received each year, you would hit that deferred inflow, hit your lease revenue, hit your cash, and hit your lease receivable. And with that, I'm going to move on to a building lease with a rebate. A utility enters into a lease for a building for a non-cancelable term of 10 years with fixed payments of $15,000 are due at the beginning of each year. At the end of the year, the utility is entitled to a rebate, a lease incentive of $5,000, and the discount rate is 6%. So if we have a non-cancelable lease for 10 years, it's going to be a 120-month lease. It's because, again, it's non-cancelable. If it would have been cancelable, it would have no longer been applicable under GASB 87. So the question is, how do you go ahead and do the initial entries for this discount? And how would you handle it? So since this thing, there was fixed payments of $15,000 are due at the beginning of each year, your first year would just be at the $15,000 because it's due at the first of it. So you wouldn't have to present value what's due today. However, in the supplemental years, you would have to present value that much, those years from year 2 through year 10. And in year 2, you would have to reduce your payment amount by your incentive and the fair value of that incentive, or the fair value of that incentive. And I know it's kind of hard to do examples without actually having them out and be able to see in person and look at them. So I can make these examples available if our marketing group can email them out after this. And with that, I will move on to AJ for GASB 88.
All right, so we'll go through a few more here. 88 was another one like 83. It was really implemented at the same time, had a slight delay. Most people have implemented this, but there's a few that haven't. So this is really just about some of the debt disclosures. And so what this statement had done is it kind of just reviewed the existing standards for disclosure. So if you move forward here, a couple slides, Tina, it's going to get to the definition of really for the disclosure purposes, what we're looking at. Okay, so when we look at what they did is they updated the definition for what debt is. And so it's a liability that arises from a contractual obligation to pay cash or other assets. Okay, in one or more payments to settle an amount that's fixed. A couple of things that are excluded in that is going to be leases and accounts payable. Those are excluded from that definition for disclosure purposes. And really, when we look at what the new disclosure requirements are on this next slide, it's going to talk about the direct borrowings and direct placements of debt. Those need to be distinguishable from other types of debt for all disclosures. So previously, some people had lumped those together, and they need to have a little bit more clarity as to what that type of debt is. A few other things that need to be in there that have been kind of hit or miss over the years is any sort of amounts of unused lines of credit. Previously, you were always saying how much you'd drawn on that line of credit, but we need to actually disclose how much is unused. So if you got a $15 million line of credit you haven't drawn on, you have to say that there's an undrawn on $15 million line of credit. Any sort of assets that are pledged for the collateral of the debt would need to be disclosed. So if you put something up as any sort of collateral, needs to kind of give that information. And then any sort of terms that are specified that are, I guess, deemed significant, right? So termination event, a subjective acceleration clause, any sort of event of default, right? Any sort of financial related consequence. So that's really all 88 is it's a more detail in the note disclosures. Okay, so we'll launch this next poll question here.
Thank you, AJ. Let's get the next one up. Number 5, I'll read it out, and as always, I'll leave it on the screen. So question 5 asks, according to GASB 88, what should be distinguishable from other types of debt for all disclosures? Is it direct borrowings, direct placements, all of the above, or none of the above? And I'll let you proceed whilst people have time to answer.
Perfect. We'll go ahead and go through the next statement. 89 is going to be for the accounting of interest incurred before the end of the construction period. So really, previously under 34, all this other information, you could capitalize your interest as part of a construction project. So GASB's kind of changed what that looks like, but you didn't have to. So again, there was diversity in practice. People were doing it, some people weren't. So if we look at what the statement really breaks down to here on this next one, it talks about recognizing that interest cost, right? And how we're going to recognize it as an expense. So in the government wides, you recognize as expense. In the fund financials, you recognize it as an expense and you go forward with it. So this is truly the easiest statement to ever implement for GASB. You just don't capitalize interest any longer if you have been. You don't go back and change anything because it's going forward, and you just expense the interest. That's the entire genesis of the statement. So it's not super complicated. So really, as this gets implemented, you just don't capitalize interest anymore, which again, not everyone does that anyway. So Rob, if we want to close out that poll question, or I'll turn it over to Tina for 90.
Perfect. Let's get your answers in quick, last 5 seconds, and we'll close out number 5. Here we go, ending the poll. I will share the results. There we go.
And all of the above is correct. So 78% yes.
All right, and with that, we'll jump into GASB 90. I know it was kind of torturous going through 87 with those examples, but not having them in hand. So GASB 90 is a clarifying statement on whether a majority interest should be reported as an investment or as a component unit. So ultimately what happened is we saw a lot of diversities in practice, and this GASB addresses how this should be, they should be reported. They're effective for periods beginning after December 15th, 2019, and early application was encouraged. So the first question in determining how to present this is, does the majority equity interest meet the definition of an investment? So GASB 72 paragraph 64 defines an investment as a security or other asset that A, a government holds primarily for the purpose of income or profit, and B, has a present service capacity based solely on its ability to generate cash or be sold to generate cash. So if this meets the definition and we say, yes, it is an investment, then we measure the investment by applying the equity method prescribed in Statement 62, paragraph 205 to 209. An exception, though, should apply for the fair value in accordance with 72 is special purpose governments engaged only in fiduciary activities, fiduciary funds, and endowments. If we say, no, it's not an investment, then we need to report as a component unit. And we need to recognize an asset for the majority interest and measured by applying the equity method prescribed in Statement 62. So if a government acquires an 100% equity interest in a legally separate entity that does not meet the definition of an investment, then it should then be recorded as a component unit. We should look at this component unit and remeasure its assets, liabilities, and deferrals by applying acquisition value as described in Statement 69. The government holding the 100% equity interest would recognize an asset and measure by using the acquisition value. These provisions would only be applied prospectively. And with that, we'll jump into polling question number 6.
Thank you, Tina. Question 6, and you may have just spotted in the chat there that the examples are going to be put out, the GASB 87 examples are going to be put out for everyone after this session, so that's awesome. So I'll read the question quickly, and it reads, if a government acquires a 100% equity interest in a legally separate entity that does not meet the definition of investment, it should recognize as a component by applying acquisition value as described in, is it GASB 10, GASB 68, GASB 69, or GASB 72? Tina, I'll let you proceed and we'll keep this up for a moment.
And I'm going to hand this over to AJ to go ahead and do conduit debt obligations.
Perfect. All right. So GASB 91, conduit debt obligations. Really, as GASB looked at this, it's been probably 20 years since they've looked at anything as related to conduit debt. So again, they wanted to eliminate diversity in practice. You see a trend a lot of times when it comes to GASB is that they put the information out, people implement it, and it's a little bit convoluted, and people are doing it differently. So then they kind of clarify some items here. So that's what they're doing with Statement 91. So as with all things, they've defined it. So if you look at the definition, there's a few things to determine what is conduit debt. So they've put a definition out, and it's listed here. Tina, I think we might be stuck. So go forward to the next one. So there's at least 3 parties involved. So you're going to have the government issuer, the third party who's the borrower, and then the debt holder is a trustee. So you're going to have those 3 different groups that are going to be related to meaning what conduit debt is. And then the issuer and the third party obligor are not within the same financial reporting entity. So it's not like a component unit and the primary government. It's a separate third party. Okay. The debt obligation is not a parity bond of the issuer, nor is it cross-collateralized with other debt of the issuer. So it's not really their debt. Okay. It's not anything that's somebody sort of cross between those. The third party obligor or its agent, not the issuer, ultimately receives the proceeds. So that third party is going to receive the proceeds from the issuance itself. And then the third party, not the issuer, is primarily obligated for the payment of all those amounts. So you've got those 3 parties, they're not related to each other. And the third party is the one who's really getting the benefit, the resources, and responsible for the payments. Okay, so that's the definition of conduit debt. So as I've kind of looked through what those are, they've also put in some other information about like some limited and additional voluntary commitments that are extended by the different users. And so generally the issuer's commitments are limited to the resources provided by the third party. And then under voluntary commitment, the issuer might voluntarily decide to make debt service payments or request an appropriation for a payment in the event the third party is going to be unable to pay. Okay. And so these are kind of important because you've got some recognition requirements as you understand the way these limited items are, or the voluntary commitments are, or even occasionally on this next one, I'll talk about occasionally an issuer may extend an additional commitment to support the debt service in the events of the third party obligor's default. So if there's a more obligation pledge or an extending an appropriation pledge, okay, pledging its own property, if that government's gonna pledge some property to that, some sort of financial guarantee. These types of pieces go into where we need to put a recognition in. So for recognition by the user, okay, so you do not recognize a conduit debt obligation as a liability. So if it's conduit debt, it's not really debt of the organization itself, and so you don't recognize it as a liability itself. Now, you may have a related liability arising out of some of those additional or voluntary commitments. So if you've got this additional commitment, you're going to report a liability when the qualitative factors indicate that it's more than likely more likely than not, the issuer is going to support the debt service payments for that obligation. Now, those additional commitments, there's a list of qualitative factors in paragraph 13 of the statement of 91 that you're going to help to go through those. So if you have this additional commitment, you're going to have to go through those different factors to determine if you need to report that liability. And then the voluntary commitment, so if a certain event or circumstance is going to occur, then you report a liability again, if it's more likely than not that the issuer is going to have to support that debt service payments. Remember, that issuer is going to be that government. Okay, so then you're going to have to, again, reevaluate these, whether, under those voluntary commitments, you got to annually reevaluate whether or not the recognition criteria is met on the debt that's outstanding. Okay. There's also some other items that are in there. There's the arrangements and capital assets. So a lot of these conduit debt obligations, are these going to include these arrangements that involve capital assets to be used by the third party, by the issuer. Now, a lot of those arrangements would be characterized as leases. Okay, so you may actually somehow be leasing as well. So you're going to have to consider those lease requirements. for a lot of times it's going to be related to the capital assets to build or acquired with the proceeds of the debt, or the issuer is going to retain title to that capital asset from the beginning of the arrangement. And this reminds me of a county years ago we worked on that has, but they were actually the obligor of the debt. They were related. They were supposed to be paying for it as well, but they had constructed these jails, and there was a group that was actually servicing those jails. And so there was this real convoluted way of disclosure. It was ultimately determined that they were liability of the county itself, but it's things to be looking at because they might actually be leasing these entities over to the operators. So it's things to consider when you have those types of arrangements that you might need to look at, okay? And so if we also look at the arrangements and capital assets, the accounting by the issuer, okay? So if you're the issuer of these arrangements, you do not report those arrangements as leases, and you don't recognize a liability for the related conduit debt obligations. And you don't recognize a receivable for payments. And if the arrangement meets the definition of a SCA, you follow statement 60. So anytime you're looking at these types of arrangements, you're going to be considering service concession arrangements. You're going to be considering whether or not you do actually report as a lease or not. A lot of times they're excluded. Okay, on those arrangement capital assets, you're going to be looking to say, what kind of liability do you have to report, because you might have some sort of voluntary contribution. Or any sort of actual financial obligation later on, and then the note disclosure itself when it comes to conduit. So all of that's a way of saying this, it's a convoluted statement, and it's not necessarily easy to go through. So anytime you have one of these agreements, you have to work through every single agreement on its own to determine, does it make sense? And then lastly, so when we look at these arrangements and capital assets, right? Like, does the title pass to the third party obligor at the end of the arrangement? So anytime, so this is kind of a little checklist that you kind of walk through to say, does it pass? Yes or no, right? So yes, then you don't, if the title passes, then you don't have to issue or recognize an asset, and you don't have to issue, have a new sort of inflow or outflow. No, but the third party has exclusive use of the entire asset. So yeah, you might have a capital asset when the arrangement ends, but you don't have a deferred inflow or outflow of resources. And then if the title doesn't pass and the third party has exclusives the only portions of the capital asset, yeah, you have a capital asset at the inception of the arrangement, and you would have deferred inflow of resources related to the inception of the arrangement as well. So again, the way these clauses work are going to be significantly important. And then when you talk about what the disclosures requirements are, you're going to have the disclosure by the type of commitment. Okay, so you're going to have a general description of the issuer's conduit debt obligation. If you move forward, Tina, so you have the description of the limited commitments, description of the additional commitments, whether it's legal authority and the limits, the link, the arrangements for the recovering the payments from the third party, if there are any, the aggregate outstanding principal amount. Okay, so you're going to have to disclose all of that information in the notes. And then if the issuer recognizes a related liability, you're also going to have a description of the timing and the recognition of that liability, those balances, the increases, decreases, kind of like a roll forward, cumulative payments that have been made, and the amounts that are going to be recovered, if any. Okay. So I think we're to another poll question. Rob, I don't think we ever closed that last one out, so my apologies.
No, don't you worry. Give everyone a fighting chance to get it in. So I'm going to end this one and let you recap the results there, AJ. So we had 44% saying GASB 72 was the standard for recognizing a component by applying acquisition value. So I'll let you recap that one there quickly, AJ, for question 6.
Well,
Hey, AJ, I'm going to jump in on this one.
Go ahead.
This one should have been on 69,
Yep.
right? So I think we had gone through before, and just kind of to run back to the slide that kind of addressed it real quick. If a component unit, if we determine that it's not an investment, and the component unit should then remeasure its assets, liabilities, and deferrals by applying acquisition value as described in 69. So we need to make sure that we're doing that based on 69 and not based on 72. And just a quick little recap, and with that, we can jump to the next polling question.
Excellent. So the next one, question 7. At a minimum, how many parties are involved in a conduit debt? Is it 1, 2, 3, or 4? So let's go ahead, give everyone a couple of minutes here whilst we proceed, please, presenters.
Sure, I'll look at statement 92. Okay, so it's an omnibus statement. So anytime you hear this omnibus, what is that? So ultimately, an omnibus statement is it's typically small, subtle changes to multiple statements and terminology that's been previously issued that don't require a full statement on their own. So anytime there's an omnibus, you just have kind of a whole hodgepodge of different items. Okay. So that's what this is saying. Omnibus projects are really going to be related to issues addressed for multiple pronouncements. So I'm not going to go through all these in detail. Just know that there's been some changes for all of these different categories. This comes straight from the 2020 that was issued here. So kind of updated the leases to change some terminology as it relates to the Statement 87 and the implementation guide. It's changed from reporting periods to fiscal years and all reporting periods thereafter, right? So they didn't want anyone to think like it's only these reporting periods and not subsequent. So you change some of those. So those are the types of things a lot of times that are in these omnibus statements. Government combinations, there was a little bit of change on that. Derivative instruments, just kind of amending some of the terminology, okay, that's been used there. Application of statement 84 to post-employment benefits. So basically there's some change in statement 73 and 74. So Tina, that's on the next one, 73 and 74 that conflict with statements 84, okay? So that'll help to clarify that. Same thing with these applicability of 73 and 74. They've again updated this language to coincide with statement 84. So that way those language all meshes together. There's a little bit of fair value measurement that's adjusted for statement 72. It's just kind of an example of non-recurring fair value measurement. So that's what they kind of have changed on that. There's not a significant change there. The following here is the intra-entity transfers of assets. So they kind of amended a portion of statement 48. So if you have statement 48 is if you have sales and pledges of receivables and future revenues and intra-entity entity transfers of assets and future revenues, there's just some clarification of how that's going to apply to all transfers of assets within a reporting entity, and remove some of those exclusions. And then I think lastly, the last thing within the Omnibus 2020 was some reinsurance recoveries. Okay, so just amending one of the paragraphs in there to clarify that the amounts that are recoverable for reinsurers are excess insurers and that claims to be paid. Okay, so they need to be reported as reductions of expenses, but not required to be. So that, if you've got a recovery, you're normally going to reduce that expense. Okay, they don't have to be. It's not necessarily your revenue. You can reduce it the other way. So those are really the only changes that are within the statement 2020. So they're really kind of one-offs, and you'll see them, but it's always good to look at those. So I guess we'll go ahead and close out that poll question, and I'll turn it back over to Tina.
Okay, yeah, let me close out number 7 here. Last 5 seconds, and last chance to get your answers in. Whilst allowing that few seconds, the examples that Tina kindly put together based on some requests we had from attendees for the GASB 87 examples, I'm being told by our marketing guys they'll be provided through an email blast that will come out in a week or 2 after this. So stay tuned to your emails for those examples and check out that e-blast, and you'll get what you're looking for. So closing the poll here and sharing the results. And I'll kick it back to the presenters. 66% said 3 is the minimum number of parties. So presenters, what do you make of that?
That would be correct. There are 3 that you have to have in that. So good job to 2/3. So I'll let Tina go.
All right, and with that, we'll jump into GASB number 93. So GASB 93 is ultimately what we're going to do in order to address LIBOR going away. So LIBOR is expected to effectively sunset at the end of this year, and this GASB is going to essentially tell us what to do in order to handle it going away. So some governments have entered into agreements which variable payments made or received depend on interbank offered rates, most specifically the London offered rate LIBOR. And as I said earlier, LIBOR is expected to go away. So what this is going to do, it's either going to change the reference rate or add or change fallback provisions related to this reference rate. So with the exception of the below, there's going to be a termination of hedge accounting, which for me, I'm like, woohoo, I'm not a big hedge accounting person. But if all the below criteria are met, you do not have to do away with hedge accounting. So if the hedging derivative instrument is amended or replaced to change the reference rate of its variable payment or add change reference rate related fallback provisions, if the new reference rate essentially equates to the old rate by either adjusting the new rate by a coefficient or constant or by an upfront payment limited to what is necessary to essentially equate to the rates. If the original hedging derivative instrument is ended and the replacement hedging derivative instrument is entered onto on the same date, and if critical terms are identical except for the term changes that are necessary for the reference rate replacement. So we'll go into that on the next slide. But remember, all of these criteria have to be met in order to continue to apply hedge accounting. So the term changes that may be necessary for the replacement of the reference rate are limited to the frequency with which the rate of the variable payment resets, the dates on which the rate resets, the methodology for resetting the rate, and the date on which periodic payments are made. So there's a two-step transition to SOFR. So one is by amending or replacing a hedging derivative to change IBOR to a new rate other than SOFR. Or two is subsequently amending or replacing the amended hedge to change that new rate to a SOFR. If number two is selected, then hedge accounting continues when all of the criteria that we spoke about earlier are met. So the first step replaces an IBOR with another rate. That interim rate is replaced by SOFR in the second step, and all four of the criteria for a one-step transition are met. So some other provisions. Effective federal funds rate and SOFR are appropriate benchmark interest rates for taxable debt when applying the consistent critical terms method. LIBOR is no longer, as I said earlier, it's no longer an appropriate benchmark because it's going away at the end of this year. Replacing IBOR as the reference rate of a hedged item does not terminate hedge accounting. Uncertainty related to the continued availability of IBORs does not by itself affect the assessment of whether the occurrence of a hedged expected transaction is probable. And if there's a lease modification because of this, that's not going to be considered in 87. So the lease modifications guidance in 87 should not be applied when a lease contract is amended solely to replace an IBOR. And with that, I'm going to move on to PPPs and APAs. So what is this? The board issued guidance for public-private and public-public partnerships, so P3s, that are not subject to Statement 60 or 87 and are improvements to Statement 60. So these SCAs, these service concession agreements that we were speaking about earlier, which were excluded from GASB 87, this is pretty much what we're going to be speaking about here. It's effective for reporting periods beginning after June 15th, 2022. So there's a lot of information when you're talking about GASB 94. So I'd like to go through just some basic definitions first, so we're talking the same language as we're going through this. So P3s are public-to-public partnerships or public-to-private partnerships. So if you have a government who's going to be the transferor, with either another government or a private company who's going to be the operator. So you have the transferor and the operator, two important pieces. These two get into these agreements, which are available payment arrangements, which are normally to provide public services by conveying control of the right to operate non-financial assets, such as infrastructure or other capital assets for a period of time in exchange or exchange-like transaction. These available payment arrangements, the APAs, are government contracts with another entity to operate or maintain the government's non-financial asset. The entity receives payments from the government based on the asset's availability for use. Assets availability may be based on the physical condition of the asset or the achievement of certain performance measures, and may include design, finance, construction, or other service components. And with that, we'll move to polling question number 8.
Thank you, Tina. So I've launched it on the screen, and let me read it out. It's a long one. It says, arrangements in which a government, the transfer or contracts with an operator, that could be governmental or non-governmental. So the government contracts with an operator to provide public services by conveying control of the right to operate a non-financial asset, such as infrastructure or other capital assets, for a period of time in exchange or exchange-like transactions. So what sort of arrangement is that? Is it a PPP, an APA, a PPC, or an ABA? So we're going to leave that one on the screen for a little while because it's a long one, takes a little digesting. So back to you, presenters, whilst people answer this one.
And I tried to give you all the answer within that question. So I hope that helps a little because I know it is a long-winded one. A P3 that meets the definition of a lease in Statement 87, but not the definition of a SCA, would be related, would be reported under GASB 87, unless the underlying PPP assets are not existing assets of the transfer, or improvements are required to be made to those existing underlying P3 assets by the operator. An APA that is related to the design, finance, or construction of an infrastructure or other non-financial asset in which ownership of the asset transfers by the end of the contract would be reported as a finance purchase of the asset. An APA that is related to operations will be accounted for as flows of resources, for example, an expense in the period to which the payments relate. So you'd expense it pretty much in the period in which it's related to. So for all P3s, the receivable for installment payments to be received would be debited, and what would be credited is a deferred inflow of resources for the assets recognizing, including payments received from the operator at or before the start of the P3 terms. If the underlying P3 asset is a new asset or an existing asset that has been improved, if P3 is an SCA, recognize the capital asset at acquisition value when placed into operation. If P3 is not an SCA, recognize a receivable for the capital asset measured at the operator's estimated carrying value as of the future date of the transfer ownership event. So these are the entries that would be made on the transfer statements. Again, the transfer is the government, the original P and the 3 Ps. The journal entries that would be made on the operator side, which is either going to be that public entity or private entity, that other party, is going to be for all P3s, recognize a liability for installment payments to be made, if any. If the underlying P3 asset is an existing asset or improvement, or if it's a new asset and the P3 is an SCA, recognize the intangible right to use the asset. If the underlying P3 asset is a new asset and the P3 is not a SCA, debit underlying P3 asset until ownership is transferred and credit the liability for the underlying P3 asset. Again, this is going to be measured at the estimated carrying value as of the future date of the transfer. And with that, we can close that polling question and then I'll hand it off to AJ.
Excellent job, Tina. So last couple of seconds here, get your answers in. Doesn't matter if it's incorrect, you just have to answer for credit. I'm going to go ahead and end this poll and share the results. And Tina, 66% said PPP. What do you make of that, Tina?
And that would be correct. And with that, I'll hand it over to AJ to go on GASB number 96.
All right, well, thank you. So we already covered 97 as part of 84. So this is the last current statement that's been issued that we're going to talk about today. So it's going to be subscription-based IT. So kind of, if we jump to the next slide here, it's going to talk about the why, right? So ultimately, what was the reason for this statement? And basically, there was concern between, again, diversities in practice. The subscription-based IT, is it covered under Statement 51? or is it covered under statement 87? 51 is for intangibles and 87 is obviously leases. So people weren't 100% sure. So what they did is they again issued their own statement. So on this next one here, we'll talk about the scope and applicability. So I'm just gonna kind of read what this definition is. So subscription-based information technology arrangement, or SBITA, is a contract that conveys control of the right to use another party's IT software alone or in combination with tangible capital assets as specified in the contract for a period of time in an exchange or exchange-like transaction. So there might be physical assets involved, but it's cloud computing in a way. So you're going to be able to utilize that information. So how do you report for those types of items? So as we kind of move forward, it'll talk about that. We're going to determine whether the contract conveys the control of that right to use. So is the right to obtain the present service capacity from the use of that specified in the contract, and then the right to determine the nature and the manner of the use, is that specified in the contract. So we have to determine, do you have the ability as a user of the financials to utilize that information? And then there are some exclusions to 96. And so it doesn't apply to contracts that convey the right to use another party's combination IT and tangible capital assets that meet the definition of lease in 87. Okay, governments that provide the right to use IT software and associated tangible capital assets to other entities through SBITAs, contracts that are P3, and then any sort of licensing arrangement that's within 51. So kind of in a summary, really here, when we look at kind of 96, we're going to have to kind of recognize on this next slide here, it's going to talk about that we're going to have to report under the provisions effectively the same as those under statement 87. So we're going to recognize a subscription asset and a subscription liability, except for those short-term items. Okay, there's going to be some measurement of subscription assets, how we kind of look at the capitalizable implementation costs based on the different stages, if there's some internally developed software, kind of like within 51. But it's kind of clarified to say, hey, these items here you use similar to 51, and the other items when it comes to that cloud config is going to be much more like 87. So that's kind of the gist of the statement. There's a lot more technical items to it, but really I want to see how it's going to impact the industry. So we've got one final poll question, and then we're going to run through the upcoming items.
Thank you, AJ. And launching polling question 9, and I'll read it out. It reads, a contract that conveys control of the right to use another party's IT software alone or in combination with tangible assets as specified in the contract for a period of time in an exchange or exchange-like transaction. That should be, that's information tech department, subscription-based information technology arrangement. It's a right to use contract, or is it none of the above? So AJ, I'll let you proceed with the next couple of slides whilst people get their answers in.
All right, so AJ and I will both be going over upcoming statements and exposure drafts. And I'm going to kick it off with compensated absences. So the board has proposed updated guidance for accounting and financial reporting related to compensated absences. And the comment deadline was June 4th, 2021. And we'll jump into what a compensated absence is and some examples. So I think a lot of us already know it's leave that employees use for time off with pay, leave for which employees receive payment upon termination of employment, or leave for which employees receive settlements through other means, such as conversion to post-employment benefits. And I think that's a piece of it that a lot of us forget about it, is the leave for which employees receive settlement through other means. So that conversion is also considered a compensated absence. Some examples are vacation and sick leave, paid time off, holidays, certain types of sabbatical leave. So absences that accumulate can be carried forward through reporting periods when earned to a future reporting period when it will be paid or settled. An absence is attributed to services rendered. When an employee already has performed the services required to earn the absence. An absence is more likely than not to be either paid or settled, likelihood of more than 50%. An exception, more than likely of not to be converted to defined benefit pension or OPEB. So the proposal measurement would be that accumulated leave. So the leave that meets the recognition criteria times the pay rate. Generally, that's going to be the employee's pay rate at the financial reporting date, plus the salary related payments. So directly and incrementally related DC pension or OPEB recognized as pension or OPEB liability, and defined benefit pension or OPEB excluded. So when it comes to note disclosures, there's no new note disclosures. Exceptions are to existing long-term liability disclosures for compensated absence. This option would present a net increase or decrease with indication that this is the net amount, and we won't be required to disclose governmental funds used to liquidate. The effective date would be for reporting periods beginning after December 15th, 2022. And as I said, right now it's up to the comment deadline just passed, and the final statement's expected to come December 2021. So we should know something pretty soon. So a lot of us are aware that the GFOA in March of 2021 asked all industry affiliates to stop using the convention comprehensive annual financial report because of the acronym that went with it was extremely offensive to some of those in South Africa. It was considered a highly offensive racial slur. This, from what I understand, has been passed now, and it will be effective for fiscal years ending after December 15th, 2021. The comprehensive annual financial report will now be renamed to the annual comprehensive financial report, or the ACFR. And with that, I'll move on to AJ, and I think AJ could probably speak to more of what he's heard that this has been passed, correct?
Yeah, as of last week, GASB met that it has been passed. The final statement's supposed to be coming out. It says October there, but I think the final statement will actually hit November. So definitely be on the lookout. I think it'll basically be effective immediately.
And with that, I'll move it to close out the last polling question and for Rob to go ahead and launch this polling question.
Okay, closing out 9 and ending the poll here now. Sharing those results, and 68% said it would be a subscription-based information technology arrangement.
That would be correct.
Thank you. And then I'll quickly pull up the next polling question here. And whilst I'm doing that, well, let me pull this up first and read out question 10 and launch this one. So this one reads, it is expected that for fiscal year ends beginning 12/15/21 and forward, the comprehensive annual financial report would be renamed. Would it be the financial report, the comprehensive financial report, the annual report, or none of the above? So again, I'll leave that open for a moment, and I'll also just read a message from our team that was put into the chat just to let everyone know that the presentation slides for today and the recording will be distributed via email. Expect that tomorrow. So, okay, back to the presenters whilst everyone has a chance to answer that question.
All right, so implementation guide update. So the every year there's implementation guides put up. I know AJ touched on it when he was going through GASB 84, and the implementation guides to me are like the Bible when you're implementing a new standard. So they have the 2018-1 has already been put out. The 2019-1 has been put out, and so has the 2020-1. When this was originally sent to us, they were saying they weren't sure when it was going to be released. It has been released, and it's able to be accessed on GASB's website. Some of the things that it touches upon is the 2018 hits OPEB pensions, a couple tax abatements. 2019 hits some cash flow reporting, derivative instruments, pensions and OPEB. And the 2020-1 hits those leases. So I think you definitely want to go look at some examples for those leases within the implementation guide. Would be a great place to go and get some more guidance. The 2021-1 also came out. It also hits those leases. So I think you should, anybody, I think that's one of the biggest statements out there is hitting the 84 and 87, because those are the biggest ones being implemented right now. And this would be a great place for you to answer some of your questions with guidance that GASB's put out in these implementation guides. And with that, let's close polling question 10 and go on to our next polling question.
Okay, last few seconds if anyone wants to get a final answer in here for polling question 10. Got 1 or 2 coming in. Excellent. I'm going to end it and share the results. 90%, Tina, said the annual comprehensive financial report. What do you think about that?
I'm pretty excited because that's probably, I think that's the top number we've gotten today. So that's a pretty important one. With that, we'll go on to the next polling question.
Okay, I've just launched that one. Polling question 11 asks, implementation guide 2021-1 is available on the GASB website, is not available, is still in review, or will not be available until next year. Get your answers in whilst the presenters cover the next couple of slides.
And with that, I'm going to say goodbye to you guys and hand it off to AJ and let AJ handle the rest of the up and coming items coming out of GASB.
No problem. I do want to mention this real quick on those implementation guides. I know Tina went over the general ones, but I did mention 2019-2, which is fiduciary. There is also 2019-3, which is specifically for leases. I would recommend against implementing a standard without the implementation guide that goes along with it, especially if there's one like that. 2 tales from practice as it relates to 84. We inherited 2 clients that early implemented. One was pre-guide, and it changed the way that they needed to implement a fiduciary fund. So there's a restatement on that one. Second one was post-guide. They did the information right, but the presentation was not up to par with GASB 84. So just know that it has been complicated. It is a process. We want to be here as you work through that, but those implementation guides are super helpful, okay, for that application. So I'm gonna just go through these up and coming. This is everything that's going on with everything else that's going on with GASB. We've already covered all of the different statements that are out there, that's coming down. So first off, we're going to talk about the conceptual framework for the disclosure. So this is my favorite, I think my favorite information here is because GASB is re-examining the existing note disclosures, right, to determine what is considered essential as it relates to the notes. So that's what they're currently doing. So here on this next slide, it'll talk about really, they're going through what the concepts related to disclosures are. So what is considered essential, right? Well, GASB's for years, they keep adding all of these statements, and now they're looking at it going, you know what? These financials are really long. We should probably relook to see what's essential and what's not. So I think that's my favorite disclosure framework. So they're still working through this. They've revised the exposure draft and put it out really for some comment. That's going to be through October 2021. So they received a bunch of comments on this information. They then abided by a lot of those, re-exposed the draft because there were some changes to it. And right now it's open for comments through October. So Tina, if you'll skip forward to the proposed concept right there. The purpose of the note disclosure is going to be to provide the information that explains, describes, or supplements the financials and is essential to the user making those financial decisions. Okay, so that's really what the proposal is what they're currently doing is they're defining what's essential, right? So we just went through 88 where they broke out all this information, and now they're looking and say, oh, is that essential? Probably, it could be, but that's what they're kind of looking at. The next one is going to be the recognition of financial statement elements. So this is another conceptual framework, right? So when we're talking about the framework of how we apply things. So this is going to be a recognition concept of how do you actually apply what is current, what is non-current. So if you'll kind of move forward here to the recognition concept, Tina, it's in 2 slides, right? So they're basically talking about the measurement focus of a specific financial statement determines what items should be reported as elements of the financial statements, and then the related base of accounting determines when they should be reported. And so if you look on this next one here, it's going to have this hierarchy, and it talks about, does it meet the definition? It's kind of this flow chart. Tina, just jump forward real quick. Right there. Okay. So it follows a specific order. So does it meet the definition of asset or liability? So yes, then you would recognize it. If no, you go to the next step. So then does it meet the definition? Oh, go back up. Of the definition of a deferred outflow of resources or an inflow of resources? Yes, you would recognize a deferral. No, go to the next step. And then does it meet the definition of an outflow of resources or an inflow of resources? Yes, recognize the inflow or an outflow, or no, don't recognize them. So it doesn't seem like it's really outside of the concept there, but they're trying to provide what is this concept itself, the overall conceptual framework of when and how to recognize them. And then they're going to start applying that into the next things here, like the financial reporting model reexamination. So GASB 34 was a huge deal back in 2000-ish timeframe. Don't quote me on the exact date. Once maybe 99. But they're changing that. So Tina, if you'll move forward, what they've looked at is they're basically saying a review of the standards found that that 34 and all those are generally effective, but there were aspects that could be significantly improved. So just so you know, the comment period for this coincided with revenues and expenses. It also coincided with the recognition model all back in February of 2021. This final statement is expected June 2022. They haven't put out anything else on this. But just I want to give kind of some of the overviews of when we're talking about the financial reporting right now that we know and love as the GASB 34 financial statement. Some of the overviews of the proposal. So here on the next one, it talks about the measurement focus. So it's going to go to a short-term financial resources measurement focus and accrual base of accounting based on the concept statements that we previously discussed. So we want to talk about the measurement focus, the format of the funds themselves. They're going to go to a current and non-current activity format, operating and non-operating. So they've actually done some defining non-operating, so like subsidies received and provided, revenues and expenses of financing, resources from the disposal of capital assets, and operating is everything else. Okay, so non-operating, they're very specific. Operating is everything else. And then proprietary presentation. So there is going to be a new subtotal for an operating loss in non-operating area. So then on the next one here, it talks about the MD&A. So there's going to actually have some clarification to the structure for the brief discussion, the emphasis level, the thoroughness required to the MD&A, and it's going to amend multiple requirements for budgetary comparisons. They're not so. Budgetary comparisons can't be presented in the basic financials anymore. So currently you can present budgetary comparisons as part of the basic financial statement or as RSI and then render a full opinion on the basic. They're not going to be able to do that. They're going to have to be RSI. Okay. There's also going to have required variances would also be final budget to actual and original budget to final budget. So there's going to now be two variance columns on the budgetary comparisons. So there's some information related to the major component unit presentation, and then some unusual and unfrequent items and how you have to disclose what those look like. Okay, so it's going to kind of replace those extraordinary and special items, and they're going to kind of change some of the terminology and the requirements there. And then the proposed effective dates, just so you know, as this coming, it's going to be based similar to 34. You had this phased implementation. You're going to have a $75 million or more on the annual revenues beginning beginning after June 15, 2022. 75 million or more is going to be effective beginning after 2024, and less than 75 is going to be after 2025. Okay, so that's kind of like the really big one I think that's coming. Rob, let's go ahead and answer that poll question, and then I'll jump into these last few topics and we'll go here pretty quick.
Okay, last couple of seconds if you're still answering polling question 11. And whilst I'm allowing a few final seconds, one individual in the chat said they didn't believe one of the poll questions, they didn't get the opportunity to answer. I think it's just one individual. I think it was maybe a technical glitch on their side, but don't worry. You only need to answer 80% to get full credit. So if you've just missed one, that's absolutely fine. So I'm ending polling question 11 now and sharing the results. So AJ, 65% of people said that the GASB Implementation Guide 2021-1 is available on the GASB website. What do you think, AJ?
65% are correct. It is available on the GASB website. If you just go under Implementation Guides post 76, it's right there. That's where they all are. GASB.org is your friend. So. Okay, last couple ones here, and we'll go quick. I know there's a lot. There's a new omnibus coming out. There's an exposure draft. It was issued in July 2021. And again, just like the previous Omnibus 2020, this one here is used to address multiple pronouncements. It really, again, not a specific project. If you just move forward on the topics to be considered, there's some remeasurement items of certain assets, liabilities, purchase options. There's not a ton in here. So the comment period is really in about 10 days from now. So just so you're aware, I am working with the TIC on this one specifically. There are some areas there might be a little bit of comment, but for the most part, there's some extension items that relates to LIBOR. There's some technical corrections that relates to some of the terminology as it relates to leases and stuff. There's not a ton in there. There is one area related to revenue recognition and in a certain circumstance that might need a little bit of clarification because they're clarifying what looks like an expense, but they don't give a definition of a revenue side. So that's a comment that we're potentially gonna submit. So just as an FYI, there's not a ton in here that I think is gonna be a huge thing. It's more terminology based. Okay, on this next one here, the prior period adjustments, accounting changes, and error corrections. So this is kind of a re-examination of statement 62. So this is kind of, if you've got a restatement or some sort of adjustment, they're putting out guidance for how do you put this information in. The deliberations were back in 2020 in February of last year, and the exposure draft was issued in May, and the comment deadline was the 31st, so about a week ago. So the deadlines went through on this. Okay, so there's a couple strange things in there. So on the next ones here, it talks about what the topics to be considered are. So we're really saying what types of events are going to constitute a prior period adjustment, accounting change, or an area correction, and what's the relationship between those GASB requirements, and how do you apply the terminology of a restatement or a reclassification or prior period adjustment. So what they're trying to determine is what does that look like. Okay, so they're putting out this guidance. There were some strange items in there that I'm hoping are not in the final draft of the statement themselves, but I don't know. One of those was actually having to have like a restatement note related to a change in major funds. That would be, in my opinion, unnecessary. So we definitely put that, and they were trying to correct errors in practice because people are doing it wrong. So that's what they're trying to look at. So then the next one here, going to talk about how useful are the current disclosures associated with it. And then, should we display the requirements? Should display requirements be established? And how do the general requirements for the accounting changes, implementation of the individual pronouncements interact? So how are those, items necessary? So I would be looking for that final statement here soon. Revenue and expense recognition. So this one here, there was some guidance for exchange transaction is limited, and guidance for non-exchange transactions could be improved and clarified. That was the reason for this. So Tina, if you want to jump forward a couple of slides here. It's really going to develop this comprehensive, it's going to be a principle-based model that establishes the guidance. So really it's going to expand where there is no guidance, right? With expenses, it's going to expand on where there's limited guidance with some revenues. It's going to consider, practice issues and challenges with the current guidance. And then it's going to consider that conceptual framework that's been issued after 33. So we just talked about what that conceptual framework looks like of when to recognize items. And then they're going to consider some sort of performance obligation recognition. So it's going to be a principle-based statement. Okay, so it's not where you can kind of work through what that principle looks like. Risk and uncertainties disclosures. So really any sort of ongoing financial economic issues related to coronavirus disease prompted stakeholders to ask the GASB to consider what government should report about the risks and uncertainties they face. So really, when do we need to say, is there a going concern consideration? Is there some sort of emphasis that we need to disclose? Are there concerns related to operations, estimates, any sort of concentrations? And that's what they're trying to give some guidance as to what these risks and uncertainties look for. So the exposure draft on this is really expected in January of 2022. They started deliberations in the fall of last year. So they're still going through a lot of this information to determine what are they going to cover, right? How much information needs to be in there about the specificity of these types of things. And then we're going to touch very briefly on the pre-agenda research. So right now they're doing research. So these are not statements right now. One of the calls that we had a couple of weeks ago actually talked about one of these items. They were just information gathering from the firms to say, hey, what's going on in these areas. So right now, they're looking, for about 2 years, they've been doing research related to capital assets, basically because people have asked GASB to review various aspects of capital asset reporting, and the most relevant standards have been in effect for 15 to 20 years. So they're just looking to say, hey, do we need to update this? The next one they're looking at is related to going concern, right? So going concern reexamination of 56. So as it's currently defined, going concern may not be meaningful for governments because they don't go out of business. So the ICPA and others have asked GASB to examine the issue. Could they go out of business? Is there going to be that concern? This has been added. This has been on the research agenda really for about 6 years. It was April 2015. So I think there's still kind of information gathering. I'm curious, with the new risk disclosure requirements, I'm wondering if there's any change on that, or if that's going to kind of update what this looks like, or if there's going to be any sort of those, because part of this came up originally with pensions, and once those large liabilities hit. Next is going to be interim financial reporting. So there's no guidance in the GASB literature for preparing interim financial statements. This has been on the agenda for a couple of years. I don't know any governments that produce full GASB interim financial statements. So they're just really trying to see, is there a need for guidance to report on GAAP for periods less than a year? So they're just kind of researching this question because it's come up. Another individual that I chatted with, they do have a client that does do a full set. I don't know if it was quarterly or semi-annually. So there's only one that I even know of. Everyone else I'm not aware of. So just as you do know. And then last on the list right now is non-financial assets. So this kind of hit the agenda last year, and they're kind of determining, saying, is existing guidance, may not be sufficient to distinguish the types of non-financial assets or distinguish them for other financial types of assets. So they're, again, going through research to say, do these matter? Are they going to be important? Is there anything to do here? So these pre-research areas are really, they haven't developed full statements. They haven't developed full committees or really anything that they're looking at GASB to come out, but just so you are aware. And then they did take one item off of the pre-research agenda. It was related to, I want to say it was investment fees. They have actually removed that because they determined that there wasn't enough there to generate a statement. So all the things that GASB is adding, I was really excited to see that they took something off the list. So that's my personal opinion. Last poll question here.
Well done, AJ. That was a lot of stuff, very well covered very quickly. So let me read out the final polling question. Everyone make sure you get your answers in to get your credit. The question is, some of the up and coming projects of the GASB include framework disclosure, re-examination of GASB 62, revenue and expense recognition, or all of the above. So please go ahead, get your answers in, get your credit. Whilst we're doing that, I know we've kind of run along on time and everyone wants to get some lunch, so we're going to wrap up here quickly, but we've received some Q&A questions in. We are not going to have time to address everything verbally live, so anything we do not address, as I said earlier, we will follow up via email, get you answers via email afterwards. But there is one that came up about the acronym for the financial statements, the GFOA acronym. And Tina, do you mind reading that question or saying that question and giving the answer up, please?
Sure. For reports issued before December 15th, 2021, do we still have to use comprehensive annual financial report, or would it be renamed? So the answer to this is the GFOA has asked that this be updated immediately. However, the GASB is effective for fiscal years ending after December 15th, 2021, with earlier application encouraged. So I would say if you're issuing a report, it needs to be annual comprehensive financial report. And I would take off the comprehensive annual financial report because of the derogatory nature of the acronym related to it, especially if it's going to the GFOA. If it's going to the GFOA, it has to have it off of it. And I hope that helps.
That does. And like I said, there's a couple of others that have come in, which we will address offline now. Final 5 seconds to get your answers in, to get your polling question credit for number 12. Again, you do not need to get the answer correct for credit. Just get your answers in, please. and then we're going to wrap this up. And here we go, ending the poll, and I will share the results, and then AJ, you can speak to the results. 91% said all of the above.
And that would be correct. And I'm just happy that beat Tina on the 90% personally. So that's just, I'm really excited about that. And I'm going to hold that over her forever.
I thought mine was like 91 or 92%.
I think it was 9. I remember 90, and that's where I'm going to leave it. I might have rounded down.
Memory.
I might have rounded down.
Well, I'm not going to get in the middle of this. I think I'll call it a tie. But thank you everyone for listening today. A huge thank you to our presenters, AJ Bowers, Tina Stewart, myself, Robert Lemon, just here trying to moderate things and keep it moving. Quick shout out, CRI does have a lot of good content. It can be found on our website. We do a podcast, the It Figures podcast, and there's some governmental specific episodes. We also have a bunch of good content on our website or social media sites. So please, check it out. There might be something useful, and keep an eye out for future CPE sessions. We do plan to do some next year, and then we hope you've enjoyed this one. So with that, I'll let everyone go, and thank you all for your time. Have a good day. Bye.